This is CGTN, China Global Television Network.
Hello there, welcome to this edition of Global Business Africa. In the course of the hour, we'll run through all the business news stories you need to know about from Africa and beyond. Quite a bit to get through, but let's start with a run through the markets here for you today. So Nigeria's bourse has not been having a good run, for lack of a better word. It closed yet again lower today in behavior that mirrors a trend we've seen over the last couple of trading sessions over the Kenyan benchmark index. In fact, its most recent peak was on May 24th. Since then, it's actually shed over 6%, fairly steadily. Over the same time frame, though, remember, MTN Nigeria is down by over 13%, and it does account for a fairly large amount of the market's capitalization. Here's what's coming up tonight. It's only a matter of days until the landmark intra-Africa trade deal goes into effect. OPEC leaders extend oil supply cuts in a bid to boost prices. And microeconomists will enjoy this one. We'll tell you why alcohol is performing better than grocery items in South Africa. Right then, our starting point tonight, however, is quite literally the bulk of the continent. The African Continental Free Trade Area will soon enter into yet another historic phase after its ratification a few weeks back. Now, African leaders are expected to formally launch what will become the world's largest single free trade zone in Niamey in Niger. Talking to CGTN ahead of that meeting, the AU Commissioner for Trade and Industry, Albert Muchanga, mapped out what decisions are expected from member states.
We're able to achieve the minimum number of ratifications in a period of 1 year, 1 month, 1 week, and 1 day. And this is very historical when you look at the pattern in the African Union system of ratifications. On average, it takes about 5 years. So we've done it in just after a year. That is very, very significant. Point number one. Point number two, by establishing this market, we're creating real opportunities for integrating the economies and come up with a large market that can attract large-scale investments and long-term investments. And that is going to create opportunities for increased employment, trade, and investment in Africa.
Now, Africa's second biggest copper producer has been downgraded to just a couple of steps above being near default. At CCC by Fitch ratings, only Venezuela and Mozambique really have worse ratings than Zambia, and both of those countries have defaulted on their debt. In its assessment, Fitch sees an extremely low odds of a fresh IMF support program, particularly since there's been little progress in fiscal reforms. The country had foreign currency reserves equal to 1.7 months of imports at the end of March, with public and publicly guaranteed debt equal to about 71.3% of GDP. Now, at the same time, yields on Zambia's Eurobonds have been rising sharply so far in the year. The market's quite jittery. Yields on the $750 million note due in 2022, those have gone up by over 700 basis points in early February to about 19.8% today. Yields on the 2024 and the 2027 notes, those have also gone up to over 19% and 16.5% respectively. They're up by 763 and 579 basis points respectively. Now, South Africa is currently in the middle of an economic crisis. President Cyril Ramaphosa recently unveiled a host of new measures aimed at getting the country back on track. But Africa's most industrialized economy is still pretty far from proper recovery. Here's CGTN's Angelo Coppola explaining some of the possible solutions expected to stimulate South Africa.
Attendees at the directors' event in Johannesburg heard from a range of speakers about how the current politics impacts the country's economy. There are two schools of thought on whether the elections signal a new dawn or not.
The political environment has changed. Even from a messaging point of view, there is a focus on growth, partnership with business, which is something that we haven't had for the past 5 years in the previous administration.
The elections, unfortunately, have not necessarily created an environment where we can deal with the structural and micro issues we need to deal with to create an environment for investment and growth.
While there's the perception of changing times, more work is needed, specifically on implementation. Critics say that South Africa is good at making plans.
But I'm not too sure that we have as many implementers as we need. Otherwise, a lot of progress would have been made in the area of implementing the National Development Plan and many other plans that we have.
The commonly held view by most analysts is that there isn't a quick fix for the country's economic growth challenges.
Whether we are going to see economic growth being revived over the short term, that is unlikely to happen. Remember, the economy has inertia. It has been deteriorating for some time. It's not going to be fixed overnight. The issues that are making the economy to grow slower are very structural in nature, and they normally take a longer time to resolve.
However, Ramaphosa now has a broad mandate from the electorate to lead the country, and he's been urged to do so.
I think that what we would urge is that he uses that mandate to rise above the fray of the politics and say, look, we are in real crisis. This is why we're in crisis. These are the short-term things we can do and we will do. These are the medium to long-term things we need to do, and this is how we're going to do it, and these are the sort of people I'm going to pull together. And rely on broad support from the country to actually back him up on that.
With the elections out the way now, it's time to get down to the work of actually making the economy grow, and that's going to take some political will from the president. I'm Angelo Coppola for CGTN in Sandton, South Africa.
Welcome back. Let's run through some quick stories making your business headlines. Kenya's Safaricom has named a board member and the company's former CEO, in fact, Michael Joseph, as interim CEO. This comes after the telecom firm's longtime chief executive, Bob Collymore, died on Monday. He had been fighting a near 2-year-long battle with cancer. Joseph served as Safaricom CEO between July 2000 and November 2010. He says he'll hold on to the post until the company finds a permanent replacement. Elsewhere, Steinhoff International has started legal proceedings against its former CEO, Marcus Euster, and ex-CFO, Ben Lagrange, to recover certain salary and bonus payments that they received prior to 2017. The South African retailer is accusing Euster, the former CFO, and at least 6 other people of being involved in inflating Steinhoff's profits and asset values over several years, forcing the company to restate years of financial results. The struggling African budget carrier FastJet has announced that after 3 years at the helm, its CEO will be stepping down to rejoin a business that he founded. Now, reports from last month suggested that the CEO could return to Mango Airlines as its top boss, a role he previously held for nearly a decade. FastJet said that Mark Hurst, its deputy group CEO, will be leading the airline until a permanent replacement has been found. And finally, AB InBev is hoping to raise as much as $9.8 billion when it lists its Asia business in Hong Kong in the biggest IPO of the year, at least for that market. Budweiser Brewing Company, APAC, is the largest brewer in Asia by retail sales. The firm plans to offer 1.63 billion shares for anywhere between 40 to 47 Hong Kong dollars. That's roughly $5.13 to about $6.02. It would essentially raise anywhere between 8.3 billion and 9.8 billion dollars. That's a run through your company headlines. It's time for a short break. You're watching Global Business Africa. Here's what's coming up next. Kenya and South Sudan agree to boost trade during President Salva Kiir's visit to the country. And a PayasYouGo Solar kit business, D.Light, secures $18 million to boost growth in Africa.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global business. Only on CGTN.
Every story starts out like this.
Okay. We'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible? And why?
Let's get
some reaction on ground. Joining us in Johannesburg is Sutra Nairobi. Hello, Nairobi.
This is how all stories begin. See how they end. Only on Global Business.
There's more to this place than just glorious landscapes. There's more to it than just, say, Table Mountain or glorious, endless salt flats. There's more to it than countries that are home to some of the deepest mines in the world. There is so much more to this place, even if it is home to some of the finest diamonds on the planet. It is the sheer diversity of the people who call Southern Africa home and the relentless drive to make it a better place that make it so special. And we know that because this too is home. No one knows Southern Africa like we do. CGTN, see the difference.
Africa is the nexus of enterprise, and Global Business will tell you why it matters.
From the mega investment projects to multi-billion-dollar mergers and acquisitions.
Africa today collects, just in terms of revenues from taxes alone, $545 billion a year. If you take 10% of that and you devote it to the energy sector, problem solved.
All this on Global Business, weekdays at this time on CGTN.
Welcome back to the program. Let's head over to East Africa now. Kenya and South Sudan have inked agreements aimed at deepening trade ties between the two neighbours. The deals were signed in the Kenyan capital, Nairobi, in the wake of bilateral talks between the visiting South Sudanese head of state, Salva Kiir, and his Kenyan host, President Uhuru Kenyatta. With the details, here's CGTN's Robert Nagila.
After almost 5 years of a civil war that has claimed more than 400,000 lives, with a further 4 million people displaced, a peace agreement signed in September 2018 has seen a resumption in oil drilling in Unity State. But for a country with the continent's third largest oil reserves, output has been sluggish. Since the peace agreement, oil production has increased to 175,000 barrels per day against a target of 200,000 barrels. For the civil war, the country produced about 350,000 barrels per day, with oil accounting for nearly all of South Sudan's exports. President Salva Kiir is looking elsewhere to spark growth. On Monday, he held bilateral talks with Kenya's President Uhuru Kenyatta.
The visit has been a great opportunity that enables us to explore comprehensive bilateral cooperation.
South Sudan was allocated 10 acres of land to build an inland dry port to spur trade and ease movement of goods. Kenya has also pledged to hold its trade expo in Juba in November. A ministerial commission met on the promotion and protection of investment, and the issue of double taxation was tackled.
I reiterate once again Kenya's commitment to continue providing any necessary capacity building support that may be required on mutually agreed terms, including development of training and mentorship programs for higher level cadre of key institutions in South Sudan's public service.
South Sudan's oil ministry says it needs to invest about $1.5 billion over the next 5 years in the oil sector. Kiir has also reached out to South Africa, signing a $1 billion deal for oil exploration and production expected to begin later this year. Robert Nagila, CGTN, Nairobi, Kenya.
Right, then let's get back to one of the stories that we mentioned earlier on in the bulletin. Zambia, of course, being downgraded to CCC by Fitch. The ratings agency basically saying that they do not have any confidence in a strong deal being arrived at between Zambia and the IMF. And they also pointed to the relative lack of progress as far as fiscal reforms in the copper-producing nation is concerned. But where does this leave bondholders? Let's find out. Langa Madonko is investment principal at Summit Africa. He joins me now live from Johannesburg. So Langa, good to see you. Zambia had at least $10.2 billion in public debt. We know at least 3 billion of that is Eurobonds. But do we know how the rest of it is divided?
Thank you very much for having me, Rama. I think we are aware that Zambia currently, of the debt that they sit with, a significant proportion, close to about 70%, is held external and about 30% is held within the local market. And this, of course, as you know, a lot of that debt would then be dollar denominated. And Zambia finds itself in a position that none of the countries anywhere would want to find themselves post the downgrading by Fitch, as well as all the other rating agencies having previously downgraded it earlier on in the year or late last year.
Right. So in March, the finance minister, Margaret Monakato, she spoke of trying to convert the debt due to China from being denominated in USD into yuan. But is that even feasible for them to pull off at this late stage?
I think the government has left it quite late, and I think trying to convert it into the yuan would have been a good idea then. And I think it would have been in line with a lot of the sentiment that is coming out of developing markets, as where they are saying, look, a lot of our debt does not need to necessarily be pegged in US dollars because we're not necessarily borrowing from the US. But I think Zambia has left it late to a point where now everybody's going to be looking at this, particularly from a China perspective, and saying, what's in it for us? What sweet now incentive can you give us for us to be able to justify moving away from a dollar-based debt structure towards a yen-based structure? And I think actually the leverage right now sits more with China than it does with Zambia in terms of what eventually happens to this debt. And as we know, relations with Zambia and China are, for all intents and purposes, quite strong, but there have been instances where sentiment has said, look, what has been the outcome of China being the lender to Zambia in terms of where the assets eventually sit when Zambia is unable to pay. And I think a lot of people will be looking at it and saying this presents another clear opportunity where China will find themselves in a position of advantage with regards to what happens at the point of debt conversion.
Right.
And the security that lies behind the debt that that China holds.
Right. But given all of that, all the things that you've actually mentioned at this point in time, should we start to expect, at least from a bondholder perspective, some sort of debt renegotiation talks between Zambia on one hand and China on the other?
I think fundamentally the negotiations will take place, because I think as a bondholder your biggest fear is default, and as a bond issuer your biggest fear is default. So if you can come to some kind of compromise that actually makes sense in terms of what the underpin for the renegotiated structure is. As we know, the reserves from a Zambian perspective are quite low, and there are bonds that are due in 2020 and 2024 and 2022, sorry, that Zambia has to be considering the repayment terms for. And if you're looking at this as China, you risk default if you are not willing to come to the table and renegotiate the terms of the debt as well as the tenure. And fundamentally then that gives Zambia some scope to be able to change the currency in which the debt is pegged. And I think from a Zambian government perspective, you really want to be pushing hard at making sure that you can negotiate with as many and as diverse a grouping as you can, because as you are aware, I think currently based on the situation that exists in Zambia, there's little scope for support from an IMF because everybody's going to be asking the fundamental question, where is the debt going to be repaid from?
Right, absolutely. One last question for you. So yields on these notes, I mean, they spiked as high as 20% last week. And even on the 2027 one, we're looking at, what, 16%, 17% or so. At this point in time, I mean, you'd have to be really, really brave and willing to lose a ton of money to go into it. But is there a reasonable case that can be made for investing in or buying into Zambian bonds?
Look, I think anybody who's going to be buying into Zambian bonds right now, as you said, is really, really brave. And they literally have to be taking a bet on that the Zambian government will continue to apply the fiscal control and corrections that need to be taken into place. They need to be slowing down their infrastructure spend, which actually is an oxymoron because, as we know, Africa needs to be increasing its infrastructure spends, and then Zambia finds itself in the precarious position where they need to be going in the opposite direction. You also have to be a person who has a highly optimistic view on where the copper price is going to go. And sadly, despite corrections in gold and platinum, copper has not really been going in the direction that Zambia would want. In my own personal view, I would not necessarily be taking up those bonds, but we always look at Africa as a place of hope, and hopefully there are people in the international market who continue to see it that way.
Indeed. Hope, of course, is not exactly quite the investment case, but we'll leave it there for the time being. Lango Madonko, thank you very much from Johannesburg. Now, just to give you an update on Zambia, the yields really on its 2022 note, 19.8%. It's an eye-watering number. Now, into the business of energy. PayasYouGo Solar Kit business, D.Light, or D-Light if you prefer. They raised about $18 million from a consortium of lenders. It's designed to help accelerate its growth in Africa. Now, the equity injection will allow the company to expand its product line, but also get into new markets and reach a lot more customers. So how exactly is this going to work? Let's find out. Ned Tozun is the CEO and a co-founder of this firm. Is with me in studio right now. Thank you very much for your time.
Thank you for having me.
Okay, so $18 million. What's the composition here? Is it all debt? Is it debt and equity? What's the composition?
Yeah, in this case, it's actually all debt. And really, as a financing strategy for the company, we're moving from equity investors to debt investors to scale up the business. And we've just seen tremendous growth over the last few years. Just to give you a sense, in East Africa, over the last 2 years, the sales have actually doubled year on year, and we expect it to double again in this next year. So the solar market,
very high growth company.
It is
because that's
booming.
50% plus a year.
Yeah, it's been actually insane. And I've been in this business for 12 years now. So the kind of growth we're seeing in this market is unbelievable. And really, fundamentally, the funding is all about supporting that growth, because a lot of that growth is driven by PayasYouGo Solar, which is basically solar where customers pay over time. So essentially, all that growth, or much of it, is actually being driven by products that we are financing to the customer.
Right. Okay. So we'll come back to that funding structure in just a bit. But because last year as well, you also raised, what is it, another $41 million, give or take?
Yeah.
So total about 91.
Yeah, that's right.
Give or take. So given all the cash that you've raised, I find it interesting that you're moving more towards debt as opposed to equity. Is that because in the current capital raising environment, finding people with patient capital, especially for a business like yours, might be a bit tricky?
Well, really, the funding from last year was all about kind of accelerating our mission, you could think of it. And our mission is fundamentally to make solar products universally available and universally affordable. So that funding was used for making more solar products. So we have a lot of R&D, a lot of new products that will be introduced to the market, making them more available, so new country expansion, even within the markets we're in, going deeper, so we really reach the last mile, and then finally making them more affordable by having new kind of financing plans for customers. So the funding now is really all about taking that foundation and scaling it, and we're finding that there's actually appetite from the debt community to be able to expand that, and fundamentally that's going to be much more scalable because the company is profitable. We don't need to be funding losses through equity anymore. We can actually shift to debt financing, which is then basically on-lended to the customer that we're selling to.
Because essentially, as I understand it, it's a pay-as-you-go system. So individuals, essentially, you have this steady stream of cash flow from 60 plus different countries you can rely on to service that debt.
Yeah, that's exactly right. And we have enough track record now where banks are comfortable looking at it and saying, okay, these cash flows are fairly reliable and we're willing to bank these, which I think is a really important inflection point for our industry.
You're sitting on a lot of consumer data as well, though, aren't you? Because, I mean, if across because I know your target was to hit, 100 million clients by 2020, was it? So, well, we'll get to that in a moment. But all of these individuals essentially pay either on a weekly basis, monthly basis, whatever the case might be. How valuable a component are you monetizing that data that you have?
Yeah, that's a great question. And right now we've been so focused on building a great product company, a great distribution business, and then a great consumer finance business that we haven't actually really figured out how to best monetize all that data that we're getting. We also are wary of wanting to make sure we protect consumer data as well. So we haven't been that aggressive in utilizing that data, other than saying for customers who are paying well, we can then upsell them to other kind of products that might enhance their life quality. So whether it might be an appliance like a fan or a TV, something that could be powered by our system, that's something that we can do based on the credit history we have from the customers. But in terms of selling that data externally, that's not something we've done. And we've even looked at things like carbon, because we've offset now more than 22 million tons of carbon. We haven't monetized that at all. But it would be lovely to figure out a way to monetize that somehow and pass that value to the customer so they can get even better value for money products.
Well, if I was a bank CEO, I'd be coming to you right now, breaking down your door and saying, I want the consumer data. Yeah. But going back to the production side of your business, because I know when you set this up, you and your wife, I believe, moved over to China in the early days. But given all that we've seen since 2017, tariffs on steel and aluminium, key inputs for your business, and then of course tariffs on other things as well. How's that affected your production? Because you're working on really razor-thin margins.
Yeah, that's right. And just pricing is so important for our markets. But what we've seen, because there's been a lot of issues between the U.S. and China. We're a U.S. company, but we don't sell in the U.S. We don't sell in China. So that kind of tariff, those impacts haven't really hit our business. What ends up having a much more dramatic impact on our business is the import tariffs in the countries that we work in. Right. So we've been starting to look at things like local assembly that can help us minimize tariffs. But when you look at, for instance, the East African environment, tariffs have generally been very low. And that's really caused this whole industry to boom. And it's very akin to the early days of the mobile phone industry now. But you look at markets in West Africa where tariffs are much higher, and the penetration of solar is like 10x less than in East Africa. And it's purely a tariff issue in my view, because the products are just fundamentally much more affordable here, where you have lower tariffs. There are tariffs, we pay taxes, but they're just not exorbitantly high, so we can still have affordable products to customers.
All right, I'd love to sit here and talk more about this because it's a massive opportunity, but I'll leave it there for the time being.
All right, great, thank you.
Thank you very much for your time. Right, then let's get back to East Africa, specifically to aviation. A suspected stowaway who's believed to have fallen from the landing gear of a flight into Heathrow Airport has been found dead in a garden in London. Now, the body is believed to be that of a man. It was found in Clapham. Police believe that the individual fell from a Kenya Airways flight that took off from Nairobi. Authorities in the UK are in touch with officials in Kenya to investigate the identity of the man and how he got into the landing gear of this aircraft. Reports compiled over the course of about 50 years show that survival rates for stowaways, especially in planes, are very, very low. So why attempt it at all? CGTN's Li Keqiang explores that question.
The man whose body fell from a Kenya Airways jet and landed in a garden in London was reported to have sneaked into the plane's wheel well before the plane set off. A wheel well is a landing gear compartment of an aircraft. While dozens have made similar attempts to travel in it, the chances of survival are low. Between 1947 and June 2015, the U.S. Federal Aviation Authority recorded 113 such attempts on 101 flights, either departing from or landing in the United States. Of these 113 people, 86 died. Wheel well stowaways face considerable danger during takeoff, cruise and landing. Immediately after takeoff, the landing gear retracts into the wheel wells, potentially crushing the stowaway. During flight at altitudes above approximately 8,000 feet, hypothermia also becomes a risk. The partial pressure of oxygen in a wheel well is below that required to support brain consciousness. Temperatures also decrease with altitude. If the stowaway does not regain consciousness and mobility by the time the landing gear is lowered during the final approach or has already died, the body may fall from the aircraft. According to the FAA, it is likely that the number of stowaways is higher than records show due to bodies having fallen into the ocean. Questions then abound as to why stowaways take the risks. Like immigrants who undertake the risky journey across the Mediterranean to seek a new life elsewhere, many stowaways are leaving desperate situations to seek a new life. It is a last resort, and even if they survive the journey, they risk arrest or deportation. The man in the latest incident is yet to be identified. Li Keqiang, CGTN.
Now, Tanzania's government intends to reintroduce a tax on sanitary pads and tampons as per the newly announced budget for the 2019-2020 fiscal year. We're about 2 days into that now. Tanzania had removed VAT on these products last year, but this failed to reflect on the shelf price of these products. Some women in the country say bringing this tax back is a huge mistake. CGTN's Li Keqiang has more.
For many women in Tanzania, sanitary products like pads and tampons are hard to come by. According to a UN report, only 20% of women and girls in Tanzania have reliable access to sanitary products in the country. These activists are working to produce and distribute affordable sanitary products. They're saying they're a necessity and not a luxury. And they say dropping value-added tax was not enough.
One of the main reasons why suppliers and private companies were not able to reduce the price when there was a tax exemption because of transport and logistics issue, it's really a headache. You know, until the product reaches the final consumer in a village somewhere, has gone maybe through 4 or 5 hands. Everyone is increasing 100 shillings, 100 shillings.
The current prices for disposable sanitary pads range from about $1 to $1.50, depending on the brand and depending on how far away the store is from the suppliers.
The government says removing value-added tax on sanitary products for women has been counterproductive, as most retailers have not lowered their prices. But the move has triggered a debate on the impact that this tax will have on girls and women.
Kenya, Botswana, and South Africa have all removed the value-added tax on sanitary products. And women here in Tanzania say the government should do whatever it takes to make the products available and affordable.
The government must think of us as it's something that's a necessity, not a luxury, because all women, when that time of the month comes, they must go through it. We ask the government to reconsider, especially for those who can't afford pads.
The government will now reduce corporate income tax from 30% to 25% for investors who manufacture sanitary pads locally. They say the aim is to attract investors, increase employment opportunities for locals, and reduce dependency on imports of menstrual sanitary products. As the tax returns this July, health experts are advising a sit-down between the government, retailers, and women's rights activists who say sanitary pads are a necessity and not a luxury. Li Keqiang, CGTN, Dar es Salaam, Tanzania.
It's about 18:30 GMT. Time for another break. You're watching Global Business Africa. OPEC leaders agree to extend oil supply cuts, but the market isn't amused. And boats in Japan bring in the first catch since resuming commercial whaling in 31 years.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant. Only on CGTN.
For a look at some economic data out of the country, the country's foreign currency reserves.
With a dedicated and diverse team of anchors, CGTN now brings Africa to the palm of your hand.
I'm Perina Karibe in the heart of Nairobi, which is bustling.
From everyday heroes to the continent's most powerful figures, we bring their voices to you.
We haven't changed. And this is something most of us are very excited about.
We bring you news that's changing perspectives. News that brings Africa to the world. CGTN. See the difference. How will your world change today? What happens here? what happens there, or what you make happen for yourself. If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
Accra is my kind of city. That's because when I'm here, I feel like I'm back home in Lagos or Abidjan, which are two of the major cities I grew up in.
Business in Africa is high risk.
After about a decade covering business news on the continent, I've learned it's all about the high risk, but also the high returns and the high energy. You simply have to adjust in order to keep pace. When I started out as a journalist, my dream was to open people's minds to the different perspectives. From the CEO in the boardroom to the trader out in the street, we all have different stories. From Accra to Addis Ababa, from Cairo to Cape Town, and I wouldn't have it any other way. Here at CGTN, we realize that Africa is on the move, and it's moving fast, but we're moving right along with it. I'm Uche Okoronkwo, and I'm a business anchor and reporter at CGTN.
Welcome back to the program. Members of the oil-producing cartel OPEC and other major oil producers have agreed to extend current oil production cuts until the end of March 2020. Now, collectively, the group has been reducing oil output since late 2017, and the last round of cuts actually cut output by at least 1.2 million barrels a day. Now, these cuts were agreed to in response to falling prices as U.S. oil output rose to make it the world's biggest producer of crude oil, overtaking, in fact, Russia and Saudi Arabia. WTI and Brent crude prices have risen by between 17% and 25% so far in 2019. Fears about much weaker global demand clouded the latest OPEC Plus meeting, but the Saudi oil minister sounded rather optimistic about oil demand in the second half of the year.
100%.
What does unequivocal mean from you? Last time you said unequivocal. That's your ambition. What does that really mean?
Unequivocal in terms of commitment by all members, countries to actually meet their obligation. That's one. Unequivocal in my confidence in where the market is going. I see demand picking up strongly in the second half of the year, and I see compliance greatly improving, and I see the length of this agreement as 9 months sufficiently long to bring inventories down and to balance the market. So I'm very positive, very optimistic, and I think we're in a very good place.
The Saudi oil minister speaking there. Now, Naweed Jabakil is covering the market. He's live in London at the moment. So, Naweed, usually an announcement from OPEC Plus to limit output, at least in the past, tends to boost prices, but that didn't happen today. Brent crude is down almost 4% at the moment. What are traders' concerns?
Well, Ramah, it's true that these announcements usually boost markets, but the trouble is that the outcome of these OPEC Plus meetings are becoming a lot easier to predict. Before the group even met on Monday, OPEC, that is, we already heard from Russian President Vladimir Putin over the weekend saying he'd agreed with Saudi Arabia to extend the cuts. That's angered OPEC producers like Iran, which is uneasy with the power now wielded by Saudi Arabia and Russia, the latter of which, remember, isn't even a member of OPEC. So there are those internal tensions that could strain the deal, but more importantly, traders, they're concerned about the fundamentals facing the markets. What we have is a weakening global economy and soaring production out of the United States, which is now the world's largest oil producer, as you mentioned. Both of those factors adding downward pressure on prices, with the continued rise of US production essentially plugging any supply gaps that are created by this OPEC deal. In fact, the growth of shale means OPEC's share of the market, global oil market, has fallen to the lowest level since 1991, and that's perhaps why we're seeing prices fall back a bit today, because yes, we've had an agreement on more cuts, but analysts and traders, they're more concerned about demand. Manufacturing remains under pressure in most major economies around the world, and so the question on many lips now is whether these cuts need to be even deeper than the ones we've just seen extended. Ramah?
Indeed. So there's some debate, as we saw over the last 2 days within OPEC, on what data to use when they're comparing stockpiles, because inventories is essentially a key measure that we keep hearing about from OPEC+. Why is Saudi Arabia in favor of that 2010 to 2014 window? And what's the counter argument for not using data that, let's be honest, is now 5 years old?
Yeah, well, a few reasons really. At the moment, the way the group measures the effectiveness of its output policy is by taking the 5-year average level of oil stocks among the OECD group of industrialized economies. But Saudi Arabia, Russia and the UAE now as well think that that target isn't really appropriate to measure how well these output cuts are doing. Firstly, as a 5-year average, it's a constantly moving target, so they argue that there's a need for a more defined measure. The second issue that they raise is that they think these OECD figures, which focus on industrialized nations, they say that it's not really a true picture of global supply and demand. According to the University of Oxford, almost 80% of demand growth actually comes from developing countries, places like India and China. So that's their second argument. And the metric that you mentioned that the Saudis are proposing from 2010 to 2014, those aren't arbitrary figures. It was actually the period before the recent oil price shock, you'll remember, which saw crude tumble to less than $30 a barrel. So it is intentional, and the data may be 5 years old, but the Saudis are arguing that it's a more appropriate benchmark. During that period, there was a surplus of inventories of oil stocks of around 240 million barrels among the OECD. The current 5-year average is a surplus of 25 million barrels. So you can see the potential implications of whether this change goes ahead. It would essentially mean there's more need to regulate supply even further, which some countries in OPEC, like Iran and Venezuela, they certainly wouldn't be happy about, because they're already under a lot of pressure with exports when you consider US sanctions.
Indeed, of course, at current prices, the budget simply aren't balancing. One last question for you. We've seen the US rig count falling steadily this year. By June 21, 73 oil rigs offline. Is it that shale producers are becoming a lot more efficient with WTI in the high 50s, or are they simply responding to relatively weaker prices and therefore taking marginal rigs offline?
Yeah, that's a good question, and it's one that's really high on the mind of many oil producers, especially those in the Middle East. Because if there's one thing that the US shale revolution has proven, Ramah, it's that American firms have become incredibly flexible. As one trader told me, it's simply a matter of US producers turning the taps off, really, whenever prices get too low. So shale players, they're proving responsive to prices, very much so, and they're also very efficient because they don't have the comparative advantages and the relatively low production costs that some Middle Eastern producers enjoy. But more broadly, an important point is that the US, it also has a vested interest in how this OPEC Plus agreement plays out. It's not simply a matter of the cartel cutting and the US filling the gap. But President Donald Trump, he's been very vocal himself in telling OPEC's de facto leader, Saudi Arabia, to increase supply in order to lower prices. Because remember, Mr. Trump himself has a very important election race coming up next year, and he thinks keeping gas prices down for consumers, that could help him keep his position in the White House. Back to you.
Indeed, it's going to be an interesting market to watch. Nabil Jabahil, thank you very much, live there from London. Brent crude at this point in time, 62.47, down 3.9% so far in the day. Now, on to another developing story. European leaders have nominated the managing director of the International Monetary Fund, Christine Lagarde, to become the next president of the European Central Bank, the ECB. Now, Madame Lagarde will become the first woman to run the Euro area monetary policy institution. She'll be replacing Mario Draghi, Super Mario as some call him, as president of the ECB when his 8-year term ends on the 31st of October. European governments turned to the 63-year-old one-time lawyer and former French finance minister after hours of negotiations over a package of top EU jobs. The formal approval of Lagarde's nomination requires a series of procedural moves, and those are expected to be done in the next months to come. Now then, let's turn to northeastern China, where the World's Economic Forum Summit Davos is being held in the coastal city of Dalian. The Chinese Premier Li Keqiang gave a keynote speech at the opening ceremony this morning. He declared China's firm support for multilateralism and said China will open up to a lot more foreign capital. CGTN's Keqiang reports.
Chinese Premier Li Keqiang shared his views managing world economic growth amid uncertainty. Addressing the opening ceremony, Premier Li said though globalization faces issues such as inequality and lack of inclusion, blaming all problems on globalization itself is not the right path.
We need to follow the trend of globalization and promote free trade and trade investment, liberalization, and facilitation. We need to promote equal rights, equal opportunities, and fair rules, and improve institutional arrangements on that basis.
Premier Li said China experienced many hardships and made many sacrifices over the last 40 years of reform and opening up. But the country is going to continue the policy, opening up sectors like manufacturing and finance to foreign investment.
Restrictions on foreign investment in value-added telecommunications services will also be reduced in 2020. Foreign-funded institutions will receive national treatment in credit investigations, credit ratings, and payments, and the two-way opening of the bond market will be expanded. China will not go for competitive devaluation of its currency.
Many attending guests said they welcome China's strong support for multilateralism and cooperation.
I think there are a lot of sectors which are applicable. In particular, from the German perspective, I think we can have good opportunities in many industry sectors, but also by selling of consumer goods.
As foreign companies in China, we're very pleased to hear Premier Li Keqiang's comment on how Chinese government is creating an equal and fair business opportunities, not only for state-owned enterprises, local Chinese businesses, but also foreign invested businesses in China.
This is the 13th edition of the Summer Davos, as today's world struggles with a slowing economy, geopolitical tensions, and conflicting ideologies. This year's forum sends a strong message that China is committed to globalization and partnerships, which will help the world become a better place and have more people enjoy the technological benefits. CGTN, Dalian, Liaoning Province.
Now, 2 Japanese whale hunting vessels have returned to port with their first catch after the country resumed commercial whaling for the first time in 31 years. The country withdrew from the International Whaling Commission last year in a move that sparked global condemnation. From Auckland in New Zealand, here's CGTN's Owen Poland.
The Greenpeace environmental group successfully fought to stop commercial whaling in the 1980s. And it says Japan's decision to once again hunt whales is a major disappointment when fish species are under so much pressure.
They're facing climate change, overfishing, plastics pollution, seabed mining. There's this whole perfect storm of threats that are happening. And what we really need to do to protect our oceans is eradicate all of the threats that we can and start with the ones that are easiest to stop, and commercial whaling is one of those.
However, the Sea Shepherd Conservation Group is looking on the bright side. It says that Japan's decision to stop scientific whaling in the Southern Ocean is a major victory, and that confining fishing to Japan's exclusive economic zone signals the beginning of an end to commercial whaling.
Japan have retreated to their own territory, and hopefully the resistance in Japan is increasing, and we're going to see, the end of whaling finally on this planet.
The resumption of commercial whaling in Japan comes just a few days after Iceland suspended its annual hunt for minke and fin whales amid growing concern about the negative impact on tourism. And protest groups believe there's also a growing belief in Japan that whaling is bad for that country's international reputation. Environmental groups called for international pressure to be placed on Japan over the whaling issue at last weekend's G20 summit in Osaka. And while Japan says that fishing will be limited and conducted on a sustainable basis using scientific evidence, Greenpeace isn't convinced.
It's extremely difficult with an animal like whales to know what the real numbers look like, and so we would disagree with that view that any quota is appropriate for hunting whales.
The consumption of whale meat is considered a cultural tradition, but the reality is that few Japanese actually eat it. Of the more than 30 kilograms of seafood consumed every year per head of population, only 50 grams is whale meat.
The time for killing whales has long ceased, really, and this is the death throes of a dying industry.
Owen Poland, CGTN, Auckland, New Zealand.
Right, then a quick run through commodity prices, and really just going to focus on oil. Brent crude, as I mentioned a little earlier. In fact, in the course of that conversation just had earlier in the bulletin, down by about 4% at the moment. So it's basically chopped up the year-to-date gains to around 13% odd. OPEC Plus, as you heard earlier, keeping the production cuts until the end of Q1 2020, but the market clearly thinks they're not going far enough. The manufacturing data that's been coming out today from the US is pretty disappointing. That's after comparable data pointing to a slowdown in Asia and the EU. Here's what's coming up next. Alcohol is seemingly performing better than grocery items in South Africa. We'll explore why when we come back.
Images may appear to be identical, but looks can be deceiving. The difference is not always obvious. It has to be discovered. There are always different sides to a story. We put the focus on the details. To see more, to understand better. CGTN. See the difference.
The greatest journeys. The greatest sights. The greatest adventures.
Here in Continental, this weir allows the locals to walk on water.
We're far more than just TV news. We're your passport to the wonders of Africa.
To bring you stories of struggle, survival and hope.
So let's explore. CGTN. See the difference.
Welcome back. Let's head over to South Africa. Gin lovers in the country only had a handful of brands to pick from, but with the rapid growth of craft gin, there are now over 200 producers in the country. Their combined turnover is over $70 million. CGTN's Alexander Majala has that story on Grassroots tonight.
Last year, gin consumption in South Africa grew by an astonishing 50% to half a pint for every man, woman and child. Distilleries are mushrooming, trying to give a colonial tipple the distinctive flavor of the Fynbos. South Africa's young entrepreneurs are exploiting the unique vegetation of the shrub and heathland of the coastal Cape.
Before craft gins came around, the gins that we had in South Africa were all imported gins. And they only used international flavors, foreign flavors. But in South Africa, we've got such a diverse ecosystem, flora and fauna, with so many unique flavors that we can actually make truly unique and very enjoyable gins locally. And I think that's a big attraction to craft gins, is being able to enjoy truly unique and proudly South African flavors.
According to the Gin Box Subscription Club, South Africa had under a dozen gin distilleries in 2015. Today, there are around 65 nationwide, supplying outlets from artisanal and farmers markets in Cape Town to the gastronomic hotspots of Johannesburg.
I love gin because it can be pretty looking. I love the flavors. I love that it's refreshing. It's very nice to drink in the summer when it's really hot.
A gin is a summer drink. It's a winter drink. Very calm, very cool. Sip it through the day, at night. Very chill drink. Doesn't get you drunk very quickly, which is nice.
Beer remains easily South Africans' favorite alcoholic drink, and the higher margin craft beers have also enjoyed a recent upswing. But analysts say the beer market, craft and commercial, has reached its ceiling and that South Africans are joining a global trend in shifting to whiskey, brandy and gin, especially women between 18 and 35.
About 10% of the value of gin sales sits in the premium category, so above 350 Rand a bottle. And that industry, the gin category, is growing at about 40% a year at the moment. in your big outlets, so the Pick and Pays and Checkers.
A 2018 report by market researcher Euromonitor International found craft spirits in South Africa were set for healthy growth in coming years, even if increasing obscure and radical botanical tinctures risked overcrowding the segment. South African retailers this year surprisingly reported alcohol performing better than grocery items in an otherwise depressed environment where consumers are spending less. With the cheapest bottle of artisanal gin averaging around $28, annual consumption around last year's 15.2 million litres or more should keep the distillers in business for a while yet. Alexandria Majala for CGTN.
Still in the country, last September, you might recall that South Africa's Constitutional Court ruled that it's not a criminal offence for adult citizens to use, possess and grow cannabis in private for their personal consumption. But according to legal experts, those unfamiliar with the legalities of that landmark ruling are at risk of prosecution, as CGTN's Sumitra Naidu now explains.
Millions of South Africans cheered after a long court battle ended with a victory for those wanting marijuana to be legalized in South Africa.
That is our intention, is to create fields of green for all South Africans, not just those who have the money, not just those who are sick, not just those who want to make socks. So we want legalization for all uses for all people. There's no marginalization here.
However, the Constitutional Court ruled that marijuana use would be allowed only by adults and in private. Industry players and activists came together in Johannesburg this weekend to see how they can lobby for further rights.
All that we can do at the moment is to advise our clients to be careful, to not carry around or possess a silly amount of cannabis or a form of cannabis which would demonstrate that, for example, they were dealing.
Despite only a sliver of legality, many are using the ruling as a means to open up the cannabis market. But any industry activity is still illegal. In May, the Department of Health removed certain drugs containing cannabis CBD from the Schedule 7 substances list, moving them to Schedule 4 under the Medicines Act, making them more accessible. Many believe that the government will in time further loosen legislation in this regard. Sumitra Naidu, CGTN, Johannesburg, South Africa.
Let's wrap up the programme with a run through the currencies here for you. So the Kenyan shilling is our focus. It's been steadily weakening from early March. It's lost about 3.5%, in fact, since then, raising quite a few eyebrows. Now, at today's levels, it actually did go over 103 to the dollar. It ceded about 0.3% to the greenback so far in the year. But why is this happening? Here's one line of argument from Gibran Qureshi of Stanbic Bank. There's been a flood of shilling liquidity coming into the market in the last month or so. Some government arrears have been paid, and the maturity of about $1 billion of short-term notes in June, and there's another $1.5 billion coming through in the month of July. That's a run through your currencies, and that's it for tonight's edition of Global Business Africa. As always, we'd like to hear your thoughts on the content you've seen here in the last hour. There's several ways to get your thoughts back to us, all of them on your screens right now. I'm Ramah Nyang in the Kenyan capital, Nairobi. Thank you for your company in the last hour. The World Today's up next from Washington, D.C.